Well, you heard the stock market is expensive. In this video, I'm going to show you, yes, U.S. large companies are expensive, but small companies are not. Hi, Jim Gore from THOR Wealth Management. Well, in our prior videos, you've heard us talk about U.S. large companies being the most expensive area of the market. And we want to show that here. If you look at this is going back to 1870s. Looking at what is known as the cyclically adjusted PE ratio. And you will note right now that the PE ratio of the S&P 500, so this is your larger companies, is over 40. There's only been one other time that it's been eclipsed, and that is back in 1999. We're not saying necessarily that there's going to be a correction in the market. We could have a number of years where performance is not there for U.S. large companies, or we could have a correction. I don't know which way it's going to go, but we're looking at valuations of the S&P 500 being at extreme levels. Another way to look at that is seeing what has happened the last 10 years. Where have the returns come from in your investment? So if you look at U.S. large company stocks, and we're looking at the S&P 500, so we're looking at on the left-hand side is the growth companies, the S&P 500, and then the Russell 1000 value. So you're looking at growth versus value. One thing you'll notice here is that growth stocks, the price of growth stocks, the index has gone up 404%. Earnings are up 174%. So over the long run, earnings are important for stocks to go up. But you can see that the earnings are much less than the price. The PE ratio, what you are paying for each dollar of earnings, you're paying 84% more today than you were 10 years ago for each dollar in earnings. So that's a huge premium. That goes back to the CAPE ratio. The PE ratio has gone up, which means that the prices have gone up in excess of their earnings. So 84%. Notice on the S&P 500, it's 57% increase in the PE ratio. And even large company value, it's 31%. It's less, but it hasn't kept pace. So you're paying more for each dollar in earnings than you were 10 years ago in U.S. large companies. And this is why we have the lowest exposure in U.S. large companies, because the valuation has gotten ahead of the earnings. Now, just use for example, that's just large companies in the U.S. We talked about small company stocks in the U.S. They are cheaper. And look at the same analysis looking at the small company indexes. So you look at this, small company stocks, you've had price go up 141%, the earnings are up 125%, so the PE has only gone up 7%. Compare that to 84% for large companies. Notice though, on the index itself, over the last 10 years, the earnings have gone up 126%. The price is up 121%. They're actually cheaper today for each dollar in earnings than they were back 10 years ago. So they're looking at 18.4 PE versus the S&P 500 of a 28 times earnings. Look at value. Value, the earnings have gone up 114%. The change in price is 96%. Value stocks and small companies have actually gotten cheaper. And we mentioned this before in our market updates. Small company stocks are cheaper than U.S. So if you're U.S. large companies, so if you're all in the S&P 500, you definitely don't want to be in that space and overweight your portfolio in that space when smaller companies are cheaper. We are still underweight equities as a whole because our Thordex is telling us that the market is expensive. And typically what happens is when the stock market does correct, small companies end up losing a little bit more because they're less liquid. And that's why we have more exposure in U.S. small company than large company for sure. But overall, we are really underweight U.S. stocks in general. If you have any questions or concerns or need help with your investments, please give us a call or reach out to us at thorwealthmanagement.com. Take care and talk to you in a couple weeks. Subscribe to the Thor channel today.